live. So as this is our second one, up front, we ask you to forgive us any bloopers. Today, we're talking about unpacking private equity. The Australian private equity market has grown significantly for a number of years to an estimated 66 billion in 2024. While the combined market capitalisation of the 2,000 plus companies listed on the ASX sits at more than 3 trillion, it has occurred alongside substantial growth in private equity fundraising and deals with Australian companies. Australia has approximately 60 institutional private equity managers, and there are also about 40 venture capital firms in the market. Today, I'm speaking with Mark Richardson, who founded private equity firm Wolseley in 1999 and successfully raised 400 million across 2 funds until his exit in 2019. Hi, Mark, and thanks for joining me.
Well, thanks, Claire. I'm so pleased you said this was your second LinkedIn Live. It's my first. So let's keep our fingers crossed. I'm looking forward to it.
Okay. Well, before we tackle private equity, I've got some fun facts about Mark. Aside from the fact that Mark, of course, led one of our very well-known WOBX cohorts to successful graduation, which is how Women on Boards became connected with Mark. But he graduated with first-class honours in chemical engineering from Leeds, spent 5 years working in oil and gas in the North Sea, was a cadet pilot with the Royal Air Force, still has a commercial helicopter licence, and was a founding trustee for the Jane Foundation, which of course protects a lot of the Rwanda and associated area of Africa. So Mark, does all this activity equate to you having a good appetite for risk? And is that why you wound up in private equity?
Well, that's a really nice introduction. Thank you for reminding me of my degree, which is a very long time ago. Private equity requires that any of the practitioners maintain quite a considerable risk profile, actually. It would be incredibly easy to not invest in any particular company at any particular time. There's always a host of things that you can look at in pretty much any company, it doesn't matter how well it's run, where if you wear your glass half empty perspective, which we always ask somebody to do, by the way, when we're looking at making an investment, but you back away 9 times out of 10. So one has to have a risk profile. After all, we are seeking returns in excess of what can be achieved on the publicly listed markets, and we're seeking to achieve those in a relatively short time frame, which most investors like. Although recently, as you've already referred to in your introduction, we have seen some longer time frame funds be created.
So describe a day in your life in your private equity firm before you left in 2019.
Well, let's try and describe Monday to Friday using the day at a time construct. Our second fund was $250 million, and if we add that to our first fund, that added up to 400 million. And we had a team of 12 investment professionals, including 2 other managing directors, alongside myself. So every Monday morning at 8:30, we had an obligatory whole of firm meeting, and we went through the entire Monday morning looking at those companies that we were reviewing for potential investment, looking at those companies that we'd already made an investment in. And remember, we were a majority control investor, so it was crucial to get a weekly update as to how each investment was going. And then after a lunch, which we provided for everybody in the afternoon, the team were free to have external meetings. So Monday was quite different. Monday was a day of internal review of the investments we'd already made and investments we'd like to make. And the rest of the week could be as varied as anything for me. It might have been a one-on-one meeting with an Australian superannuation investor, such as industry funds management that put $30 million into Wolseley Fund 2. So when they call and say they want a briefing, you basically say, okay, when do you want the briefing? I'm ready and willing to tell you everything there is. In my week, there were 2 favourite types of meeting. The first was with either a company owner or an advisor, or in fact a CEO, And if the CEO, he or she, brought in a company that they thought was of interest to us to acquire, those were always great meetings. Just a lot of fun, talking about a new potential investment. The second favorite meeting was talking to investors, who were interested in how the fund was going, wanted to know what our future trajectory was like, and talking about whether or not they were happy to come into the next fund or even co-invest alongside us.
It's interesting that you talk about that because, of course, the famous US investors, Buffett and Munger of Berkshire Hathaway, are pretty scathing about PE on the grounds that they think the business model is flawed, financing buyout with huge amounts of debt that leaves acquired companies less able to weather downturns and incentivize firms to prioritize paying back creditors over more useful long-term investment. And yet PE is a really important funding source for Australian companies. How important do you think it is for Australia to grow its PE market?
Well, at the moment, the $66 billion of private equity in funds under management represents almost exactly 2.5% of the value of the Australian stock market. In North America, private equity represents around about 4 to 4.5% of their much greater, of course, stock market capitalization. So in my view, Australia's got possibly enough room to add another 30 or $40 billion of private equity into the funds under management. And the only reason, the single reason that investors will do that is because they have confidence in the returns that they can achieve. I do want to comment on the Oracle of Omaha's perspective. I did look into those in detail, and I think Warren had a very, very good point. And his point was, if you can make good returns by buying a good company and then selling it inside 4 or 5 years, if it's a good company, why wouldn't you hold it like we do at Berkshire Hathaway, for 10 years or 15 years or 20 years? And there's been 2 responses to that. The first is that the massive global private equity firms like KKR, TPG, CVC, these are all multi-hundred billion dollar private equity funds, have actually established now, quite recently, 20-year funds. So they've got no pressure to sell a great investment. But the second thing, of course, is very, very few investors have a 20-year investment appetite. Most investors need to see a profit on their investment inside that 3, 4, or 5 year time frame. And the numbers prove themselves up very, very well. Cambridge Associates, if you don't know who they are, it's well worth having a look at the web. They analyze every private equity economy worldwide, and they've analyzed every single one of the 83 private equity managers that have existed in Australia since the year 2000. And they've looked at every single investment, and they've included all costs, all losses, all carry, and the return over that 20-year period has been 17% per annum from private equity, net of all costs and fees. In the last 10 years, and that includes, of course, the COVID crisis, the returns have been 14% per annum. Well, that's significantly in excess of the publicly listed markets. Warren's other comment, though, which I think is really good, is we always compare private equity performance to the general ASX stock market. And I don't think that's reasonable. I think we should be comparing it to the best 100 performing companies, given that private equity represents such a small percentage of the total market. But providing those returns are there, and providing we are running the private equity firms as well as can be run with all of the normal controls and governance practices that you would expect, investors will continue to put money into the Australian private equity market.
Now, you're a bit of a private equity guru. You spent a long time in it. You've now come out of it, and you are saying, what are the 3 main... I was actually just going to ask those people who are online, because a couple of people here are already jumping notes in. If you've got some questions, please do pop them in, because we are happy to take those as well. But what are 3 main misconceptions that people have about private equity, which might even be, I'm too small to do it, it's not for investors like me, that type of thing?
Well, let's talk about the investors in private equity. So we think of them as either very, very wealthy families with their family office, or overseas pension funds or university endowment funds. And then we kind of think about, we know that Australian superannuation funds invest in private equity, and every single one of them does. The bigger the superannuation fund, like the Queensland Retirement Fund or Australian Super or the Future Fund, they allocate up to 10, 11, 12% of their total funds under management, which is multiple billions of dollars, into private equity. So every single Australian who has a superannuation account, which of course is every adult worker, is invested in private equity. Now,
good point.
Most people don't take an active role with their superannuation choices. Most people say, I want a balanced fund or I want a growth fund, but an awful lot of people do have their own self-managed super funds. And if you have a self-managed super fund, it's relatively straightforward to find a position in what's called a fund of funds to gain exposure to otherwise closed off private equity funds. There's also some very, very good publicly listed private equity funds. They tend to be North American. So if you've got the appetite to invest your own self-managed super fund overseas, you can do. Alternately, go on to your industry super fund or your Australian retirement fund or Australian super, and feed in the information you want to feed in about your appetite for private equity. And the only real difference between PE and investing in the stock market is the speed with which you can recover your investment. When push comes to shove, if you really do need to withdraw some money from your, I was about to say superannuation, but of course we can't do that until we each reach a certain age, but from your withdrawable investment pool, then in the public markets, you just sell the stock. In most private equity funds, that's not possible. But nowadays, there are actually very accessible funds which allow you to withdraw your capital if you give 1 month or 2 month or 3 months notice. And both of those attributes, the longer term of a fund, that suits Warren Buffett very, very well. Equally, the opportunity to take money out of a fund, subject to a month or two's notice, suits most retail investors very well.
It's interesting, isn't it, that we think because it's called private equity, it's kind of out of our sphere. And in order to demystify private equity, which is what we've started talking about now, and explain how it really works, you created an online 5-module course called The Essentials of Private Equity, which, by the way, everyone who's online, you can jump on Women on Boards and download it there or access the course there for a fee. Can you tell us a bit about the course and why you decided to do it?
Yes, I'd be delighted to. So after 20 years of active participation in private equity, I then went to the Australian Investment Council and presented the Principles of Private Equity program to over 2,000 individuals one-on-one and through webinars. And there was a demand to make a video-based course, which I've called Essentials of Private Equity. It consists of 22 videos, the shortest of which is 5 minutes, the longest of which is 15 minutes. And it goes through the private equity life cycle, which is how does a firm, a private equity firm like Wolseley, raise a fund? Once they've raised a fund, how do they find a company to buy? And you'll hear all sorts of different descriptions of that, investments and kind of majority shareholding. But the reality is we're buying companies. Then how does a private equity firm work with the CEO where she or he can create very significant value, predominantly because they're excellent CEOs, but also leveraging off the strategic skills, the capital deployment expertise, the acquisition expertise, of great firms. That's the third part of the equation, and that part of the equation takes 3, 4, 5, 6, or even 7 years. And then finally, of course, there comes a time where the private equity firm wants to sell that particular company so they can return the profits to the investors and start the whole 4-stage cycle again. So in the Essentials of Private Equity video program, it's 259 Australian dollars, including GST. Sorry for the sales pitch. You can watch it anywhere on any device. They're yours forever to keep. And so far, roughly 100 people have purchased it, and the feedback's been, really excellent, which is very, very gratifying. Why did I do it, Claire? I actually love teaching. It's not easy actually to put together those videos. It takes a huge amount of effort. So I decided to charge for it rather than just, stick it on YouTube. And that's where we are today.
Yeah, no, brilliant. And if anyone is watching and wants to have a look at those, Mark's also been incredibly generous, and in selling them through Women on Boards, he has given us a percentage of those sales as well, because Mark is also committed to our mission, which is to increase the number of women on boards and across those leadership roles, which of course is one of the reasons that in fact you took on the WOBSX chairing as well, Mark.
Yeah, I was delighted when you asked me to, or Ruth and you asked me to chair the Diane Grady Syndicate. I think that was 2001 now. It was right in the middle of COVID. I had a
21.
wonderful...
21. You're a 10.
That's a great moment. Sorry about that. 2020. I had 14 wonderfully qualified executives on that panel, all of whom happened to be women. And we spent, a whole year engaging with different executive search consultants, different fully allocated public company directors who spoke about what it's like to be on public company boards. I'm very proud of what Wolsey did to encourage women into private equity. We were a small team, only 14 people at max. But if I look at the great firms now like Quadrant or Pacific Equity Partners or Adamantium Capital, they've got a growing proportion of women in private equity. Still nowhere near enough. And just a fun fact for you, roughly 45% of all space shuttle astronauts were women. And in the Australian private equity world, only about 5% of Australian private equity managing directors are women. So pretty long way to go.
Love that fun fact. Love that fun fact, Mark. And on that note, I'm going to thank you very much for joining us on this LinkedIn Live. Remember, 45% of space astronauts, 5% of private equity. Really, really like that. Good takeaway, good opportunity. Please do jump on and have a look at the essentials of private equity. And Mark's also happy to get a personal email from you, and he loves feedback. So thanks, everyone, and thanks, Mark.
Thank you, Claire.
Oh, we got a question.
Questions. How does PE funding differ from VC funding? That's all covered in the program. Bottom line there is most private equity firms want to take a majority position. All venture capital firms take a minority position. The key role of a chair of a company that is half funded by private equity is a fascinating topic. I've chaired several of those. We had a couple of independent chairs in one or two of the portfolio. Vicky, if you want to flick me an email, Mark at markrichandson.au. Same goes for you, Lisa. I'd be happy to dig into those questions in more detail.
Yep. Anyone wants to get onto those, or of course connect with Mark on LinkedIn as well, and he'll be able to send that too. But thank you very much, everyone, for joining us. Thanks to Mark, and we look forward to next week's LinkedIn Live.